Hi, today we are in Palo Alto in the Quest Venture Partners office. Andrew, who are you and what do you do?
Martin, thank you. My name is Andrew Ogawa. I run Quest Venture Partners, one of the three managing partners here. Andrew Ogawa, Marcus Ogawa, Martin Hüft. And together we run Quest Venture Partners that focuses on early stage venture capital investments. We were established in 2008, originally as a family office. Marcus is my brother, and we were in a lucky position to create a venture capital fund due to the fact that our father is an entrepreneur as well. Our father, at age 51, started his own company. It was a container leasing corporation, 20-foot, 40-foot ocean-going containers, and his dream was always to go IPO. In 2007, his dream came true and he went IPO on New York Stock Exchange.
Great.
And with those funds, he said, kids, one day you're probably going to come in a lot of money. You should learn how to invest. We live in Silicon Valley. This is a good place to invest in startups. And by the way, I have a golf buddy whose friend is running a startup and I want to invest in it. And I need for you guys to manage it. So that's kind of the genesis of Quest Venture Partners, originally being a family fund. I myself have more than 10 years international business experience working with a large German company called Daimler, where I was stationed in Japan, Detroit, and Stuttgart, working in procurement, international sales and marketing, as well as controlling. Marcus, my brother, has more of the overall IT experience with network solutions, web pages, and kind of jack of all trades for various IT functions. And together in 2008, we created Quest Venture Partners LLC and made the first investment in our father's friend's company. After that, we took 11 months to really build our network out, take any meeting we could with any entrepreneur, any investor, anyone affiliated kind of with the startup social network, because we realized that to be able to make good investments, it's not just about having money. It's about being able to support the founders of the startups in various different ways. It can be operationally, it can be network or biz dev opportunities, it can be thinking strategically together of what the next steps are. And especially if you're investing seed stage or first institutional money in, it's all about how can you help bring that startup to the next level so that it's able to receive financing, Series A and onward. So yeah, that's kind of how our company, Quest Venture Partners, was started. And since then, we like to consider Quest Venture Partners Fund 1 as between 2008 and kind of 2012. Where we were about a $20 million fund. We invested in 45 investments, and I'm happy to say that we've returned our invested money and more, and still have over half of our investments alive. So we're projecting a very nice return with our Fund 1. And given those results, Marcus and I said, hey, I think it makes sense for us to create something even bigger than just Marcus and Andy. Why don't we create a fund that, or a fund management structure that will last for 100 years? So how are we going to do that? What we need to do, obviously, is bring on even better people than us. So bring on more talent, increase organization, as well as we need to then increase our resources or funds. So we brought on a new managing partner named Martin, from Google, where the last 4.5 years he was with the Android team and a technical program manager for the Nexus devices. So with Martin on board, he brings a tremendous amount of technical hardware and software due diligence capabilities for us with regard to mobile devices in general. And then we are now Fund 2 and targeting a $45 million fund, which is a lot larger than our Fund 1, but we will still be focusing on seed stage, Series A stage, first institutional money in, and being able to follow on B and C if necessary. And basically, as a target for Fund 2, we want to, with our initial investments, try to have around 7 to 12% equity stake in the company, invest anywhere from $250,000 to $1.5 million as an initial investment, deploy 45% of our total fund size as an initial investment, and hold on 55% for follow-on investments. So hopefully within 3.5 years, we make all of our initial investments and have just our follow-ons to manage.
Great. When you said you started with this kind of family office,
Yes.
which is more perpetual in terms of nature,
Mm-hmm.
when you raise money from limited partners, it's more of limited in time, mostly 8 to 12 years.
Mm-hmm.
How do you manage this kind of different, let's say, philosophy in managing fund?
Mm-hmm. The philosophy for our investment actually resonates well with a lot of our LPs. We believe in open communication, transparency, and a sense of integrity with a relationship between the investor and the founder of the startup. Likewise, when we address our LPs for investment into our fund, we also stress the fact that we believe in open communication, transparency, and a sense of integrity. Hence, a lot of family offices who are looking to invest into startups are considering our fund as investment because they can relate to those 3 guiding principles, and also to the fact that obviously we have come from a family office. So we believe in long-term relationships over short-term quick wins. And I think in general, in early stage investing, you're investing really in the founders. That idea is important, but for us, the idea has to be interesting, and it has to be able to address a scalable market or a large enough market. And maybe that's 20% of our decision, but I would say 80% of our decision is all based upon the founders and the character of the founders. If they get knocked down, are they going to stand up and continue to fight? How emotional are they? Or are they very pragmatic? Questions we also ask a lot are like, what do you want out of this company? Or how do you define success? Are they experienced entrepreneurs that have already sold companies many times before? Hence, unless they get 100 million or above, they're not going to exit? Or are they fresh out of college, newer founders who may, be a bit more pragmatic about exit opportunities, because if they're suddenly offered $15-20 million, it's a life-changing event for them, right? There's no right answers if you should sell early or no, you can wait till 100, but it definitely ties in with the ability for the investor to be able to get their money back. So this is something that investors will always be asking. That being said, to get back on track with your original question, we really believe in establishing this open relationship with the founders, so that if there's something wrong, they don't call us afterwards. They're calling to us, before. How do look, the giant iceberg's coming to us? How do we get out of the way, as opposed to, oh, we got hit and how do I fix the boat? So we want them to call us before a big issue happens, but we also want them to call us, be the ones that they call when they say, hey, I landed the first $1 million deal, and share that excitement. And that can only happen when you have, open, transparent communication with the founders, and you're working together to try to achieve this goal.
Right. Andrew, let's talk about Quest Venture Partners. You said that you are in the early stage investments, so mainly seed and A Series A. What type of industries or business models are you looking for in investment?
Well, we're kind of known as mobile guys here in the Valley, but that's a very general topic these days, now that there's so many apps and everyone, obviously you need some sort of a mobile device presence. But especially bringing Marna on board and having his Android knowledge base, I think we like focusing on mobile applications. We also like O2O, so online to offline. So how do you interject technology into your day-to-day life to make things more efficient or more pleasant. And that also encompasses introduction of new platforms to allow people to meet or exchange information somehow. Finally, we also look at creative e-commerce. So not your typical e-commerce solution, but something with a twist or a zing that sets it apart. Those three are, categories are ones that we like a lot. Obviously, Internet of Things is one that also is quite fascinating, as there's going to be more and more devices with various types of switches or sensors to it that can help make life better.
Can you walk us through the typical investment due diligence process?
Yeah, so usually we'll meet with the founders in person, and we tend to meet all three of us with the founders at once so that all of us have an initial impression. If we like our first meeting, we will then have a follow-up meeting, and we want to usually visit their office and meet all of the team. In the meanwhile, we'll find out if we know of any investors who have already talked to them to get their impression. We'll try to identify if there are any other founders or people who have worked with the people who are presenting to us to get their impression. And then we'll obviously look at competitive landscape. We'll try to get a better feel for the total addressable market. And then after that second meeting, if we're further interested, we'll obviously communicate, hey, we're very interested. And we need to start to get a better feel for what sort of terms the founders are looking for in their financing. Obviously, valuation is a very big component, but liquidation preferences, is this a convertible note or equity round? It can change, obviously, the deal tremendously. Likewise, existing capital structure, understanding the cap table of the company. Lots of times when you have many investors in your startup for very small amounts, things can get kind of tricky. And there's, friend and family rounds. Sometimes a lot of people do convertible notes with very low valuations or some strange terms in it, which unfortunately makes it more difficult, as a company gets bigger to receive subsequent rounds. So one company recently that we were planning to do a convertible note, once we identified the cap table, we saw 3 different classifications of convertible notes from friends and family rounds for 3 different caps and various different, amounts invested. We said, hey, founders, I think it probably makes sense better to do an equity round. Why don't we clean all this up? And this will also help you in the future to secure Series A better. So yeah, we need to look at many different components, but I mean, obviously the most important one is actually the founders. What kind of character do they have? Usually, obviously, past experiences lead to who you are. So we try to understand how they got to where they are. We try to understand what they want out of the company, as I talked about before, and and reference checks are very important.
Andrew, how long does it typically take from the first contact to signing the contract?
It varies, but I think we're more on the quicker side because it's just 3 of us, and 3 of us are on the investment committee, basically. And if one of us says no, then it doesn't happen. But if we all agree, then things can proceed fairly quickly. If they have a clean capital structure and no previous major investors, I would say we can do a turnaround easily within a month, if not earlier, to be honest with you. If it's a convertible note, it's quite quick.
Can you tell us about some investor pitches that you liked very much, and tell us also why you like them very much?
Well, I like investor pitches where the founder uses a lot of past experiences to exemplify why they may have learned something, or why they may be acting differently, or why they may pursue a different strategy. Because then it helps, build a bond of understanding where the individual came from and how they've grown from that situation and how they plan to implement the knowledge or experience that they gained from the past towards the present. I don't like presentations or pitches where the founders come in and believe that they know everything. And don't want to listen to advice. It's very difficult if you're dealing with a founder that's not coachable. Not all founders need to be coached, but they have to be willing to entertain different suggestions and ideas and actually trying to implement them before, and seeing if they work, as opposed to just totally shutting things out or pretending that they know everything or that they're above. Hey, why are you questioning me? I know what I'm doing. Obviously you don't have the a pleasant interaction at that point, and you realize that in the future, after I invest in the company, this founder is probably not going to listen to any of the suggestions we make, or we're not going to have a good repertoire between each other. So yeah, from the beginning, if the founder knows everything and isn't really willing to listen to suggestions, it's usually a big red flag. Those that are willing to entertain ideas and have a conversation that allows for back and forth is always a plus. Transparency and kind of this open communication is how we want to build upon our relationship, and those that can kind of explain how they got to this conclusion from past experiences are usually ones that retake second meetings and want to learn more about their team.
Andrew, let's talk about the market and some business models that you like very much. If you look at the market sphere, whether it's in Silicon Valley or abroad, what type of markets do you think are very interesting for entrepreneurs to tap into, or what type of business models?
Well, recurring revenue business models are always nice, as opposed to one-time upfront plays. Because if you're providing a service that generates any level of satisfaction to the end user or the customer, they're going to want to continue to use it. And as long as you're not reminding them that your service is great or your service is bad, I guess for that matter as well, they're going to continue to pay for it. So I like SaaS models with recurring revenue, and hopefully with low implementation or barrier to implement. Those ones tend to, it may take time in the beginning, but so long as your turnover is low, your revenue builds up consistently and is a little bit more easier to plan out. I also enjoy platforms. It may take some time to actually construct the platform, then to bring the people onto the platform. But once you have a K factor or a virality that's higher than the initial people coming in, you're going to consistently be gaining, and people are going to want to come back to the platform, and to be part of the platform, then they're going to have to either pay on a transactional basis or a subscription basis. The thing with platforms, though, is you always have to have some sort of a hook that makes them want to come back to the platform, as opposed to meet someone and then go off the platform and communicate directly. We have a very interesting startup that we invested in called Dog Vacay, which is kind of a Airbnb for dogs, pet owners. And as opposed to me leaving my dog with another a pet shop or a kennel, I'd rather leave my dog with another dog lover. So through the platform, I can identify someone who's willing to host my dog while I'm on vacation. I can see the ratings. I can go to the mobile app and see photos and videos and give the dog a bone. And they've been tremendously doing well over the past 2.5 years, and we're very happy to be a part of that. But their hook for their platform is that they provide insurance to the dog sitter and the pet owner on both sides, just in case something happens. As well as, if the dog got lost, they're pulling all strings they can to try to, pull resources to find the dog. So they're very customer service oriented. But by providing that hook of the insurance and being able to, review and see those reviews, that's what allows people to come back and not stay off of the platform. So if you're creating a platform business, it's great if you can pull everyone together, but you need to make sure that there's a reason why they continue to stay on the platform, as opposed to meet people and then go off the platform.
Great. Our readers are mostly first-time entrepreneurs or people interested in starting the company. What advice can you give them when they want to start or maybe even scale a company?
There's a lot, but first of all, I think it's very important to identify a co-founder that you can heavily rely upon. It's basically you're almost getting married to them, maybe without the nightlife part, and you're gonna have to be dedicated. Things aren't gonna work as you expect it all the time. And so how do you deal with frustration and stress and anger and things not working your way? It's probably through communication with your co-founder as well as your own social, I guess, network. Maybe your significant other, your spouse, or an advisor or a mentor. So one, find the right co-founder. If you're not a technical person and you're just going to choose any other technical person as a co-founder because they can code, make sure that's the right person. Don't just choose them because they can code, because it's going to impact you for the next few years at least, right? Then once you have your founders in place, I think it's always wonderful to have mentors or advisors to bounce your ideas upon. But you shouldn't try to find a mentor or advisor just because they have a high profile name or they're known in the community. Yes, I'm sure they're wonderful people and they have great experience and they could help a lot. But at the same time, they're probably very busy and active with many other startups, and you may not get the full support that you need. So find someone that's really actually going to be willing to take the time and work with you and help you identify issues early, Then you need to, come up with your business plan and actually start implementing some of this in the market and testing and starting to get feedback, because most VCs aren't going to fund you just for your idea. They want to see you try and get some feedback from the market and, have more data points before they invest in you. So how do you build your product out and get it out to market quickly so you can start getting some initial feedback that you can then iterate on and improve upon is your next goal. Sometimes it depends on your business model, but sometimes it takes a lot of money up front, sometimes it doesn't. Hopefully you chose one that didn't. And then, I think whenever you are ready to then go present to investors, and this is after you've talked to your friends and family who are willing to put maybe some money to support you, but once you're ready to go to your investors, I think it's very important to explain once again how you've come to where you are, why you believe that this may be successful, and what points have you tested out so far to kind of support that thesis. You won't have the answers for everything. I think that's a very important thing that you have to keep in mind, that be upfront with investors as well. They listen to 1,000 pitches a year or whatnot, and I think it's you don't need to show off or think you know everything or have an answer to everything. Sometimes if you don't know the answer, you can explain, I don't know what it is, but my guess, or I would presume or assume, because when you present a business model and I see like revenue forecasts and all this, the numbers actually don't really mean anything to me. I like understanding what the premise is, what made you feel as though that you would be able to attain this much market share. I'm not worried about, you're going to get 10% market share. I'm more worried about how you came up with that thesis. What are the premises? So be able to explain how you came up with your model, so the building blocks. I'm not so worried about the actual number, but what's your idea behind the building blocks is more important to me. So when you go to present, don't pretend like you know the answer to everything. Don't have answers for everything, but make sure to explain why and how you came up with your thought, because that's the interesting part.
Great. Andrew, thank you very much for your time.
You're very welcome.
And starting a company is very adventurous and it can be very hard at sometimes. So if we are on our next quest, maybe you should think of Quest Venture Partners.
Thank you, Martin. Vielen Dank.
Gerne.